Today's Beyond the Basics is just going to be kind of more of a high-level introduction to mergers and acquisitions law. I don't know, do you guys practice that at all in your areas?
Our firm does,
Okay.
but on the level of small business.
Oh, yeah. So I guess, do you guys typically do more buy side, sell side?
Both.
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 Okay. I'm doing a lot more of this. Well, my name's Jared Olson. I've been doing this for 3 years, so you guys probably still have more time in the industry. I come at it a different angle though. I'm with the firm advisors. We're an advisory broker group, so I don't represent buyers or sellers. You know, I more or less work as an intermediary between the legal teams to kind of help and work on that side of things, as well as kind of an in-house counsel, as well as just an intermediary. So what I'm covering here is going to be very high-level basic, probably stuff that you guys may or probably already know, and some of it's also going to become my color commentary, which what I find to be, I think, would be solid practices. You may or may not agree, but I'm the one with the microphone. So mergers and acquisitions, just the basics. I've kind of broken it into four very broad kind of areas, just to consider as practitioners, and because I've tried to take it this fact that, you know, we as practitioners, we're not just here, you know, in the M&A process, it's too easy to think of us as just we're here to write the contracts, or we're here to draft the documents and redline the crap out of shit, which is arguably a very big part of what the M&A practice is. But I think the practice, especially in the guidance, needs to start a lot sooner in advising the clients on even before the sale starts or before they put their business on the market, because I think the process arguably should be starting a lot earlier. I've been doing this for 3 years. In that time, we've done about, over 200 deals, worked with various different businesses, many even more that wouldn't sell, because by the time the business owner decided they wanted to put themselves on the market, they weren't really in the best position for it at the time. And so I think just some high level topics I wanted to kind of cover about, starting even before we get to the table, before we even have a buyer that we're looking at. What are some of the things we need to consider as a buyer, for buyer clients, for seller clients, going through the process at a high level? Obviously, you guys have probably already done this yourselves, and then kind of wrap up with some high level, just some considerations, my takeaways, my little soapbox about how we as attorneys in the industry can be more cognizant of the effects we're having on the process and how to better it in our way. So the first step one I always talk about is knowing when to sell, especially if you're a buyer, or knowing when to buy, knowing when to sell if you're a seller, knowing when to buy if you are a buyer. So for every sale, there's three main reasons that somebody wants to sell: divorce, death, or retirement. Those are like the big three. Obviously, everybody has a little bit different. Sometimes sometimes they just want to get into a different industry, or sometimes they just want to try something new, or they just get sick of it. I've had a few business owners, they've been doing the same thing for 30 years. They're just kind of sick of it. They want to try something new. Big major three, I think it's always important to keep in mind what is the motivation here, because number one, that's going to be factoring into what you want your bottom line to look like. If you're going to be going on to another business or another industry, how should we be looking at non-compete agreements? If you're looking to retire, what do you need? What does the seller need to get out of the deal in order for this to actually make financial sense for them to live off of this retirement? If they're getting a divorce, what are the deadlines that we have to follow so we can try to get this all wrapped up in time for the courts? And, same thing with death and probate. You're typically dealing with who you have to deal with and who all has to be involved in the process. And then, of course, there's always that very serious question before somebody decides, is this the best time actually to sell? Like, do I have to sell right now? In the case of divorce, death, there's obviously not as much choice. But, if you don't have to sell now, it's always worth kind of keeping in front of mind as to what you're looking to get. If your goal is to get, the most money possible, is the market in a good spot right now? Are the multiples and the market rates and prices for the types of business I'm selling in a favorable spot? is there a lot of people buying? Are there a lot of people lending? Obviously, we started to get into a little bit of a slowdown last year. We saw in our part of the industry in 2022 because with interest rates and a lot of people worried about the economy, like the second half of 2022, everybody just kind of pushed pause. They wanted to wait and see how things would fall out. Fast forward to Q1 of 23, now we're seeing a big influx of people. Like they've been waiting, they had their money ready to go, and now they're feeling a bit more comfortable with the scenario. So now they're here. They're looking to see what they can get and kind of really push the button. So, it's not, even if you think you're ready to go and you want to sell, it's always worth being cognizant and kind of advising our clients as attorneys too, about what are you looking, like have a clear picture in their mind about what they're looking to get out of the deal and what their deadlines they have to work around are. So for the buy side, step 2 would be kind of preparing for the sale. I'm going to break this up to buy side and sell side. So obviously building their teams, arguably, since we're all attorneys here, we're going to say that we're the most important part of that team, telling them how and where to go and what they should be looking at in their documents. Any arguments? Good. We can agree on something. But there's also other people, if you wanted to, depending on, obviously there should be an accountant at some point, who can be ready to look over financials and help provide some insights on those, as well as lending partners. If you have somebody, have some banks lined up and you can at least work their credit to make sure that they are personally viable for lending, always good to have, as well as if they're looking for something very specific, then it may be worth bringing in a broker or some other kind of searching agent to help them find that needle in the haystack. Or if they're searching for just something that's local, I'd be surprised how many times I get a phone call from somebody saying, I just want something in Omaha. What do you have? So depending on what they're looking for, you want to have a team to make that work. I think step 2 is understanding your needs and abilities as a buyer. Obviously, this is part of a conversation we have a lot with buyers is, we always kind of ask, what are you looking to do? Like, what can you actually afford? We try to be very delicate about it, like how much money do you have? But what can you afford? And you can very tell the people who are prepared versus the people who aren't. There's the prepared people. They're saying, well, I have up to $800,000 to put for a down payment. I'm planning to get an SBA loan. Gives me about a 10% down. So that's kind of my buying power right there. Gives you a good range. Whereas we have others, they kind of dance around the topic. Well, what's your budget for this acquisition? Well, that all depends on how much cash flow is in the business. It really doesn't. More cash flow means a bigger price. How much can you actually afford to buy? But, if you don't know what you're looking for, you get people who are looking at, they'll be looking at both, that $900,000 restaurant bar as well as the $10 million distribution company because it's, hey, it looks nice on paper. I could maybe swing that with my 9-to-5 job and my rental house. You never know. Kind of tying in there as well with the understanding your financial resources, I think I got a little ahead of myself. In addition to financial resources, what are your needs and personal abilities, I guess is what I probably meant with that first one. In addition to, what your money is, what are you bringing to the table as per individual? Are you a strong salesman? Are you really more of an operations person? How do you see yourself fitting into this business? Like, are you looking for a business that, needs an everyday manager? You need somebody, your ability is to get in there, is work, 40, 50 hours a week, bust your ass and, make good money. Or are you looking for something with a management team that you can take high level, you can work on development, you can work on sales, and you can grow systems and processes. Where are your strengths as an individual buyer? And that'll kind of tell you what kind of business you're ready to run. Is this your first time buying a business? Have you ever run anything like this before? Are you ready to jump into the deep, the big $50 million business? Or do you need something that's a little bit more, frankly, going to be fewer moving parts and easier for you to manage yourself? Yes.
Jared, do you ever tell people that are really hot to try on buying something? You say, I enjoy your energy and your creativity, but you need to go to Business School 101 and come back once you've read these books, done these seminars, things like,
Yeah.
Is that really that sort of direction to give some people?
I definitely have to, sometimes we do have to try to like tone people down. The irony here is actually some of the people that are the most hot to trot is the people it's like, well, I worked in corporate America for 50 years, but now I got my MBA, or I got my MBA from Harvard. Okay, great. Well, how are you going to afford this business? Well, I have some investors who may jump on if it's the right deal. Says, okay. What other businesses have you run? I just graduated. Says, great. I love your energy. You know the basics. You know what's in the textbooks, but at the same time, that's going to be very different. So, oftentimes, like the newly minted MBAs are often some of the most energetic and most enthusiastic, even if they've never run a business before. So, obviously, it kind of takes it's a different energy. There's nothing wrong with this being your first business or first acquisition because you all got to start somewhere. But it's all about matching your background, your expertise, your understanding. And what you can bring to the table, to what you should be looking at.
And you're not going to close a deal if you think it's going to fail in 2 years.
Well, yeah, and if you're talking to Joe who built this $20 million trucking company from the ground up, he built it with his bare hands for the last 20 years, and you're telling him, I've never run a business before. I want to buy your business. He'll tell you to pound sand. Because, this is his baby, this is his family legacy. He wants to make sure the person taking over knows what they're doing. So it's really about helping yourself and making the whole process easier all around by knowing what you can get into and kind of knowing your limits in some ways. And then finally, understanding your criteria. I think this kind of falls from option numbers 2 and 3. Go into this, what are they looking for? I always kind of ask like 3 major questions when people are asking about business, like say they're looking for a business. Number 1, what industry are you looking to get into? Do you have specifics? Very oftentimes, most often people are flexible, but often they also come up with the same answer. I'm pretty flexible, but I don't want any restaurants or bars. You get that a lot. Other people are like, well, I don't know. I've never given it much thought. Or I'm only looking at e-commerce because this is what I know. This is what I've done. I've built this before. I already own 2 more of these. I'm looking to add on to them. So it's really knowing where your focus is can help you find the right opportunity. Next 2 is geography. Where do you want to be? If you're, you live in Omaha, your family's here, all your kids are in school here, you and your wife have jobs here. And you're probably not going to want to pick your whole family up and move to Arkansas for a business. And it's going to be about, you need something local. That's great. You got to kind of tailor what you're looking for what you can have with what you can use. And then finally, size. Now this applies not just to, how many people are in it or how many people are under you, but also then we always talk about in terms of, EBITDA, revenue size, like how much money do you need to make out of this? If this business is going to be your livelihood, say you're walking away from, $100,000 paycheck at your day job, how much money do you need to have coming in after paying your bills to make this make sense for you? Minimum, gives you a range. And then, of course, how much can you actually afford? So, these are the internal conversations that our clients should be having, but they don't always have before they dive into trying to go under contract with a business and really, spinning themselves in circles. Step 2 would be, now on the south side, I think this is a little bit of my soapbox where I've kind of talked about it before. I think this is where I really push that even more so when you're looking to sell a business, the process should really start far, far in advance. And this is where most often we as attorneys are going to already have these clients who they own a business. They're going to be our clients in many instances before they're ready to sell. And this is when we can kind of advise them in early stages on, if your plan is selling, what are we looking to do here? So obviously, same thing is build your team. They'll have, the attorneys, the accountants. They don't need the lenders as much, but definitely the attorneys, the accountants, and whoever's going to be handling. There's a lot of paperwork. There's a lot of files that you have to pull during due diligence. Who can handle these details? Cleaning up your books. Who here has owned or has owned a small business before? Who here runs personal expenses through the business to help lower their taxes a little bit?
Not anymore.
I've done it, and I do it because I'm not looking to sell right now. But as the bottom line is, it's very easy as a small business owner to, put your phone, your car, your meals, everything is like through the business so that you can write it off as taxes. And so, you can try to take a loss on your tax return and say, hey, I don't have to pay any taxes this year, right? But trade-off to this is when you eventually go around to selling the business, the SBA goes off your tax returns. They don't care what your internal P&L says. They go on what the tax return says. So if the tax return says you lost $20,000 the last 3 years in a row, they're not going to lend you crap for that business. So it's really, this is kind of a big one that we run into, that, you can try to do what you can to add it back, and you justify saying, well, this, you can, don't look at this much of the expenses because these are personal expenses. You can trust me, wink, wink. But in order to really, like, the businesses that seem to go the quickest and have the easiest transition and quickly the fastest sales tend to be the ones that have the cleanest books. Fewer add backs, if you know your plan is to sell, even like I'd say give it at least 2 or 3 years in advance, try to run your books as clean as possible. You'll have to pay more in taxes, just suck it up and pay more in taxes because you're going to get the money back with some extra at the sale time. I think that's really what you see. And then understanding your exit plan. I think this is something that starts, arguably, I'm a very believer that kind of starts from when you first take over or start your business, is you're always kind of looking at what your eventual exit plan is. It may not happen in 10 years, or 20 years, or 30 years. It may happen next year, but how do you want to see yourself leaving this? Are you, looking to retire onto the golf course? Are you looking to hand it off to your kids? Are you looking to have them just, drag your dead body out from behind the desk when you just die in your office? What would you see? How do you see yourself wanting to go at that point? And so that would be, and that's going to kind of circle back to, once you have an exit strategy in mind up ahead, that'll give you your guidance on how you can plan for it and when you need to start looking at getting these in line. And then lastly is creating systems. And this one, I think, is another problem. It's like similar to cleaning up the books, except I think it takes a little bit even more advanced planning to really get yourself ready. We've had so many businesses come through our doors, and you may have heard of businesses that said, yeah, we did, I did, 1.5 million in sales last year. Okay, great. How many employees do you have? Oh, it's just me. What can I get for the business? That's, realistically, we've all seen it. I don't know if you guys have any of you guys have heard of Michael Gerber or read any of his books. He's a big author on business systems. He does a book called E-Myth. He's a very big proponent of systematizing. He's a very big fan of his favorite business is McDonald's and their model. And, obviously everybody writes off McDonald's like they make crappy food. But realistically, the McDonald's business model is they're not really selling the food, they're selling the business model. If you take yourself out of it and think of it yourself, if you're a new business owner, you're going to buy a restaurant. You can buy Joe's Cafe, where Joe is the chef. He cooks all the food. He runs the back office. The business lives and dies with Joe. Or you can buy a McDonald's franchise where they give you the handbook, step-by-step instructions on how to make anybody with a half a brain can make money off of this franchise. What's going to be a more appealing idea as a buyer? Now, obviously, there's a lot of room in between. And with all due respect, I just pulled that logo off there. I know there is actually a Joe's Cafe in Omaha. I've never eaten there. Not going to disparage anybody. So, but when you're looking at planning to sell your business, if you want to get the best value you can, realistically, you need to be focusing on making the systems that work when you're not there. If the business only works while you're there, if you are the source of all the business, if you're doing all the sales, or if you're the one bringing in all the contracts, all the relationships go through you personally, then you don't have a business, you have a job. You may be an amazingly well-paid job, but you have a job. And if you want to try to get away from that job and maybe get some money out of it, then you need to kind of be able to give that job to somebody else. So that was my soapbox. I can step down from it now. But I think those are the four things that I think really a lot of business owners need to understand better than they do, is that the sale process really should be starting with the preparation months, not years in advance. You should be always cognizant, how do I want to get out of here?
Jared, can I ask a question here?
Yes.
Emotional connection to their business that they say they want to sell, but there is a illogical emotional connection on how they want the person they're selling to do it, to run it in the future.
Oh yeah, you get the emotional connection on that, where the business owner, realistically, they probably should just turn over the keys and leave, but then they get the idea, well, I could stick around and help, and then they get into a big fight because they don't like the way the new person's running it, and frankly, things go downhill. A lawsuit ensues, and a lot of people lose money. Or they'll just walk away from a good offer because they think, well, I don't like the feel of this person. And sometimes it's justified, sometimes it's not. We were selling an HVAC contractor out in Hawaii. And one of the buyers came in. It was a big national conglomerate that owns HVAC companies all across the country. They have a lot of money. They know the industry in and out. Great. They came in, but they were really just kind of rude and dismissive of the entire team. And candidly, they told the owners, if anybody leaves after they close, we'll just replace them. And he was just not a fan of that because he built this team. They were he wanted to take good care of him and his team, and that was important to him. And that it's an emotional connection to your point. And these guys were all about the bottom line. How do we do it the quickest, the most efficient, the cheapest, which makes them money, but it can alienate the self-made man model of a business owner. So emotional connection isn't always a bad thing. On the other hand, when you'll also have the emotional connection issue where the owner, they may have made $500,000 last year, but they won't let it go for less than $4 million because they feel that that's what it must be worth, because that's their blood, sweat, and tears are in the business. There's got to be a happy medium, and there's always. I think a good business owner should have an emotional connection to their business in some way. If you don't, then you probably should have left earlier. But obviously, it's kind of about it's up to us as attorneys to kind of help manage the emotions. I would say it's full candor, and I apologize if anybody else has been doing this. My least favorite area of practice, because I've done different areas of law before I came here, my least favorite area was family. The old adage I always heard was, in criminal law, you meet bad people on their best behavior. In family law, you meet good people on their worst behavior. And it's just that emotion just overwhelms all the reason in the room. Now, coming over to mergers and acquisitions, there's a lot more logic, there's a lot more reason, there's a lot more positivity because we're all working toward a common goal, but I find there is still a lot of that emotional overload. When the emotions get overwhelmed, then in our clients, in our sellers or buyers, they get too emotionally invested. They don't necessarily think about all the logical implications or what they can reasonably get in a scenario. And I think that's another time when it's good our role as attorneys too, to help, as advisors, to kind of give some guidance in the fact that I understand, this is what you think your business is worth, or this is what you want to see. And if that's what you want to hold out for, that's your prerogative, but you're probably not going to get it. You can hold out for this absolute perfect buyer who's going to meet every single thing you want, and they may show up. They may not. You have to understand that. But if you're on a deadline, if you want to retire this year or next year, then you may need to make sure you're looking at the whole picture, not just the initial knee-jerk emotional reaction. So
it's the counsel outside of necessarily totally legal, but emotional, logical counsel. Yeah.
And I think I think it falls under that, just the advising, because I think attorneys in this process, I think in my experience, they seem to have the most impact and the most influence over their clients, like buyers and sellers, in this whole process. They'll look to their accountant on the numbers, and they'll look to their family on some personal matters. But most of the time, these people have never done this before. We're guiding people like buyers who've never sold a business and maybe never bought a business before. So they don't really know what to expect. They don't know what their business is going to go for. They don't know what sounds like a reasonable deal for them. And again, there's a lot of an emotional investment here. And I think the attorney is the person they're going to most often turn to say, does this sound like a reasonable deal, or is this something that I should consider? Should I put a counter offer, or what should I do here? So we are in that position where we're going to become the trusted advisor, and I think obviously we'll, we want to make sure that we can address that. So we've kind of covered everything like leading up to it, and now I'm just going to do a quick kind of overview of the sale process. For those of you who don't do it, sounds like we have a few pros in here. So, and we'll kind of go through a little bit what I think things to expect, things that often are common pitfalls that we kind of see sometimes. So in the sale process, we always kind of start with, I kind of break it into 3 phases. Phase 1 is the inquiry. So if you're a buyer, this is when you start looking. If you're a seller, this is when you put yourself on the market, whether you're working with a broker, working with an investment bank, just putting up your own ads on Biz Buy Sell, whatever you want to do. How are you getting the word out there that I am for sale? Do you already have somebody in mind? You can skip, if you already have a buyer on the line, you can kind of skip this section and move on to the initial review. Once you bring somebody in, they're going to want to see something. If you're a buyer, this is when you typically see something. We usually see, there's always usually a non-disclosure at this point, and then confidential information memorandum, or SIM. So that's kind of like the next step, because you put up a very, very generic information on the website, but to get the real information, to get the financials, to get the the information on the clients, you got to sign a non-disclosure, of course, and that's always got to be a must, because obviously protect your client's interests. They got to make sure that they're covered. I think that's definitely something that we can always push as attorneys is, before you share anything private or confidential, make sure they sign a non-disclosure so they can't try to use it to compete against you or take any customers away. So pushing the non-disclosures, then there's going to be the confidential information memorandum. You can put this together yourself, or you can have somebody draft it up for you. Usually it involves financials. They're going to want to typically see I'd say usually up to 3 years of financials, or at least the last full year. You probably want to get an overview on what the client base looks like, what your team is, what's your kind of a little overview of your business, the narrative side of it. What do you guys do? We sell the best damn widgets in town. We have, most of our business comes from repeat customers, or we're out there making sales every week. This is when you kind of do a little bit of salesmanship and really kind of push what your strengths are without necessarily glossing over the weaknesses, although some people would probably disagree with that. So they're going to find the weaknesses eventually. That's the whole thing. There's always going to be some follow-up questions in this time period. Usually, you may feel that your client may feel that at some point there's going to be phone calls between the buyer and seller, maybe even in-person meetings if everybody's local. They can kind of sit down. This is, once they've gotten past, we like it on paper, we like the numbers, but do we like the culture fit? This is where you start to see if there's a match. If the first in-person meeting between a buyer and seller could really tell you all you need to know if there's going to be a good relationship there. If they click, they can then, if the buyer and seller really click together, they can usually overcome a lot more hurdles and obstacles. If they're all just kind of arm's length, then it's either going to be deal or it won't. And oftentimes it'll just fall apart on the littlest thing.
Jared, to that point, in that period, the attorneys don't want to get in the way of necessarily that bonding, right?
Yeah, they typically don't, and frankly, realistically, I was going to kind of get into this a bit more. This is more like advising your clients on what to expect in the process, but realistically, at this initial stage, 9 times out of 10, you as an attorney are probably not going to be involved. You can obviously, if your client wants you to be involved, you can, but you're billing like what, $200, $300, $400 an hour to sit on the phone or to babysit these people in a conversation. Is that really the best use of their money or your time? It can be. If you think there's going to be a volatile situation that you need to be there to diffuse, or they really want you there and they want to certainly do that, you do what they got to ask you to do. But this is going to be part of my kind of coattail this into later, is to throughout this process, we definitely want to be advisors, but how do we make the most efficient use of our time and our clients' money, since they're paying us, for our time here to do this. Always keep in mind for the buyers and sellers, this is not due diligence. This is not the time to ask for the last 10 years of financials. This is not the time to ask for a detailed month-by-month breakdown of financials for the last 3 years, or ask for a copy of every single contract you've signed. We're not there yet. This is initial. No real reasonable seller is going to want to give that to you until you've signed, until you have an offer on the table. And realistically, no reasonable buyer should be asking that, or is going to spend the time and legal costs or accountant time to review all these contracts before they even know they have a deal. This is just initial to see on the high level, does this look good on paper? We'll look for skeletons in the closet later on. So that's the next step, is typically the offer or letter of intent. And so offer, like the letter of intent, for those of you who don't know, or they're usually interchangeably. If you're trying to sound fancy and really, sophisticated in the space, we'll call it a letter of intent to purchase, or an LOI. But really, at the end of the day, it's just an offer. An offer is an offer is an offer. You put the high level points. What's your price going to be? What are your kind of deal structure you're proposing? What do you kind of see as a transition time going off? What are you looking to buy or not buy? Do you want this to be a stock sale or an asset sale? What's your timeline? When do you think you could close this by? And then, of course, it's not definitive. This isn't something that if somebody decides, I'm not interested, walk away, you're in breach of contract, we're going to sue. This is basically, we have a general understanding of what the terms are, and we're willing to move forward. Think of it, it's always has contingencies too. Lays out what do we need to see to happen. Most commonly, we have to be able to complete our due diligence and review everything to our satisfaction. We have to be able to get bank financing, because we're not going to pull all this money out of our own bank account. We have to have approval from them. We have to be able to get the contracts, these key contracts, assigned over to us. If we can't do that, then the business isn't worth anything. These are always, these contingencies will typically be laid out so everybody knows, there's a big if there. If we can get all this to work, this is what we're willing to pay for the business. Really, it's a sign of good faith, and it gives the parties confidence enough that they can start the due diligence process. Because due diligence is time consuming. Due diligence is expensive in many cases. It's really something that you want to kind of make sure you have a good idea of what you're going into, but it's also something that you need to do, in my opinion, needs to be done before you get to the legal documents phase. Now, this is something I've butted heads with other attorneys before. There are attorneys, I haven't met any in this part of the country, but especially out east, a lot of attorneys are of the opinion that you don't need an LOI. An LOI is a waste of time. You should all just negotiate a whole contract before you can start due diligence. Seems to me that that's going to be a lot of legal fees and a lot of time and effort before we even know if the guy can qualify for a bank loan. But different people have different philosophies on that. So my opinion, and since I'm the one teaching this, I'm telling you, you don't need to go like a deep dive legal contract here. You don't need a 20-page document LOI to get this point. Our focus at this point is to a high level. What do we think the price should be? What do we think how much do we want to put on a promissory note? How much are we bringing to the table at closing? Do we want to do an earnest money deposit? What are our contingencies? What's our timeline for closing? What do we need to see happen next? Those are kind of the things that we want to iron out. And if everybody looks good on that paper, then we can say yes, we start the due diligence process. Now, just as a resource here, I kind of included, this is the kind of a template that we offer. We kind of provide just as a blank form at the firm. People use them, people mark them all to hell sometimes. But it's just pretty straightforward. It's I think it's like a 3-page document really here. So, you have the purchase terms, how much you bring in, how much you're getting from a bank, how much are you doing on a note, what contingencies are there. Usually, you want to be able to inspect the property. You want to be able to look at the financials. You need to be able to get a bank loan. You have to be able to agree on working capital. That's going to usually be one of the more contentious points you'll talk about later on. That's why you kind of leave it open, because you don't want to have that fight now. you have to be able to, get all the contracts done, and everybody agree to the final agreements. You have to get a lease. Typically they don't own the property; they're leasing the business. If the landlord won't sign a new lease with you, then it's no use to you. So, in cases of a franchise, you want to get approval from the franchise. When we kind of set a proposed closing date, some rough deadlines. These are just good faith efforts to try to keep the process moving. And then, we reiterate that this is not a legally binding contract. It's just an understanding that we're going to try our best to do this. And if for any reason you need to leave, you leave. Now, this is kind of like a general shell. The one other item that may come up in an LOI, and it's usually for bigger businesses, is exclusivity. What you'll find is, this is an example of a non-exclusive or letter of intent, meaning that you can take this, they can go on due diligence, but the seller is free to look at other offers. They're free to bring other buyers in. If they find a better buyer, they'll tell you to pound sand and go with somebody else. Where if you as a buyer are intending to spend a lot of time and energy to do a really deep dive, bring in your accountants, bring in their accountants, bring in your lawyers, and really spend a lot of money on this process, oftentimes your buyer will want to have an exclusive LOI. And typically, that's usually when you'd want to have some sort of earnest deposit. And you'll say for X number of days, we're going to be exclusive. You can't, you won't entertain or solicit any other offers. You're going to give us a fair chance to look at this. If we don't close before that or before that's over, then you're free to look at other offers after that. Again, these are just high points that you typically will expect to see in an LOI, but it's also, keep in mind that this isn't the same as like a real estate purchase. It's going to be very much different. It's much more free form, much more flexible. These days, if you're buying a house or commercial real estate, at the end of the day, you're probably using a form contract that the realtor uses for every single one of their transactions. They all pretty much, one looks exactly like the other. What I find to be the beautiful thing about mergers and acquisitions is that everything's negotiable at the end of the day. Obviously, depending on, if you're going with the SBA, they have their regulations, the lender has what they need to see. But beyond that, if the buyer and seller can agree, if the seller wants to do, 80% on a seller promissory note, they can do that. I would advise them not to, but they could do that. It's very much a free form, so it's everything is negotiable. You can make an offer, you can put a proposal you want to put up there, and they may say yes, they may say no, you never know. But I think that's just kind of, I don't know. So, hold on. Oh, good, I didn't lose that. So that's just kind of the LOI at this stage. My soapbox moment here is just going to be, I'd say, we need to, an LOI, I think is an important step, and I think it's much more important to again, not spend too much time, trying to iron out every single deal point, because we don't even know if we can have a deal yet. So my advice would be not to try to overly litigate an LOI. Wait to see if there's actually bank approval, or wait and see if they actually want to close a deal, and then you can get into the legal documents where we can really be cooking with gas. The final most important thing I'd say of the LOI is that this is the necessary final step to start the bank process. Any number of banks will send you emails saying you can be pre-approved for a business. Just like they say you can be pre-approved for a house. Really doesn't mean anything. It means that you have decent enough credit, you have some assets that they could lend to you, but they're never going to actually approve a deal or approve a loan, let alone an amount, until they actually have an offer on the table. No bank is going to look at a deal until there's an actual LOI or offer or contract on the table that they can really say this is a good deal for itself. So, really opens the door for that. So once you've kind of started, and once you've got the LOI in place, then you can really start the diligence. And then that comes in kind of two waves. First is the financing. So, you can reach out and get some pre-approval in advance if you want to save yourself a little bit of time, but realistically, they're gonna ask for the same things anyway. Again, they need to have an LOI in place before this. And they're going to always the bank's going to send their own laundry list of things that they need to see, from tax returns to financials to insurance documents, all that. So it's going to be, again, they're going to have you pull information, and the quicker you can turn that over, it's going to be a lot of hurry up and wait. Give it to the bank and wait for them to get back to you. In this kind of the stage, I think it's also worth noting, because there's going to be a difference depending on the type of business you're looking at as to whether you're looking at a commercial loan or an SBA loan. And for those who aren't in the SBA, or when I keep saying that term, means it's a Small Business Administration insured loan. You're getting it from a bank, and then they're going to basically lay it off on the SBA. The SBA promises them that if you default, the Small Business Administration will basically absorb, I think it's 70, might be 75% of that loss for them, so they're not on the hook for it. And so the bank is much happier to give those loans because they have lower risk. So that's why an SBA loan also typically means that there's going to be a lower down payment. They can let you get away with as low as 10% down. And they don't actually need as much like collateral in the business, because the SBA will basically just take a blanket lien on everything you own. Your house, your car, anything in your name is just they want to, they can come after it. But that's just, they're much more flexible because they can be, and because the federal government can throw away money, I guess. But they do. Some might say they already do. But whereas a commercial loan, typically, they're much more flexible on their restrictions. There's not as much red tape. You don't have to go through the government restrictions. Typically, you have like one board at the bank who makes the decision. You can often make that kind of decision in a week or two. They can look it over and say, go, no, and be done. So it's faster. They'll usually want more money up front. They'll need to see more collateral in the business, because since their bank's going to keep that on their books. But they can also be very flexible. These are the deals where if you want to do something really wonky or flexible, say you want the owner to have a larger note, or if the owner wants to carry some equity in the business and be a minority partner for 2 or 3 years, those are the kind of deals that you go through another type of bank. Because the SBA won't allow that. Just a quick overview, SBA, you have to buy 100% of the business. The seller can't keep any equity in it. And the seller can only stay on as a consultant for 12 months at most. And if you can't extend it, 12 months is the cutoff. So, granted, not to say that people don't stay longer and not tell anybody, but it's just kind of, once on paper, the SBA, they're a great opportunity for people who couldn't otherwise be able to afford a business, but they're also very strict in their requirements. That's what's going on here. I'm not sure why it's going backwards. Okay. And then the second thing to look at is the bank you're going through. If you're looking to get an SBA, you also want to keep in mind, are you going with an SBA, just an SBA lender, or an SBA preferred lender? And these are two very different things. So most banks can be an SBA lender, which means they'll do their initial review of a potential loan. They'll gather the information that the SBA requires, package it all up nice and tight, and then they'll send it to the SBA. And then the SBA does their own review separately, oftentimes for like months. So it's definitely not a fast process. And they'll get back to you when they get back to you. If they approve it, they'll send it back to the bank, who can then approve the loan and do it. So that obviously, if you're a buyer or a seller, that's not necessarily a step you want to go. But if you go to the SBA's website, they do have a list of their preferred lenders. These are lenders that do SBA loans all the time. They've gone through basically a background check process through the SBA. They have a relationship as a preferred lender. They get audited, I think, every year. So the SBA will go and check their loans. But because they're trusted, because they get audited regularly, they can make the decision. So they follow the SBA strict guidelines, but they don't have to send it off. They make the decision in-house. They can usually get you approval within, in my experience, within 3 weeks. So assuming you get them everything they need, an SBA preferred lender will be able to get you closed a lot faster than just an SBA lender. So little thing you find a lot along the way. Also, just a little fun fact, if you're ever trying to buy or sell a franchise and using an SBA loan, the franchisor needs to be registered with the SBA. If they're not, the SBA won't loan them. So, a little fun fact there. We ran into that twice. So now you've got, the bank's working on their stuff, you're going to give them everything and you're going to wait for 2 or 3 weeks. What are you going to do with your time? Due diligence. Now is when you start, by this point in time, this is when you're going to ask for everything but the kitchen sink. This is when you can kind of do whatever you need to see. This is your chance to dig in the closet, find every skeleton, ask for everything you need to see. Now, I would advise people to be reasonable, but at the end of the day, this is your chance. If you're going to find something, this is your chance to find it before you sign the paper and pay any money. So you want to be as thorough, as reasonable as possible. That's not to say, if you were to go on, typically you start off with a request list. My advice would be to have it kind of one ready ahead of time, but by the time you sign the LOI, because the sooner you get the list to the sellers, the sooner they can work on it and start the process. Because oftentimes they can be big, they can be small. It all varies. Here's one, an example. I don't see it. Here's an example of a list we had on one of our deals, and this is about $1 million deal. So, employee documents, financials, inspections, insurance policies. This is more of a retail business too, so there wasn't as much on like the long-term contracts issue. But it's a little over a page. $1 million deal, about a page, depending on what actually applies to the business. Bigger deals, I've seen diligence lists as much as, I've seen 25 pages of list. That's just the listed requests of items for big businesses. Then I've also seen people try to offer 12-page lists for small businesses because it's very easy. If you Google due diligence list, you're going to find a lot of templates out there. And a lot of people, especially if you don't know what they're doing, they'll just take it, hey, this is good. But my advice is always to, tailor your list to what you're actually doing. Don't just like pick and choose. Because the probably one of the most time-consuming things in the process and the most frustrating things from a seller who's trying to gather information is if you give them a list and half the things are not applicable, they're wasting their time trying to figure out what you're looking for, and it's just going to piss them off. So remembering, of course, that if you push too hard or you be too much of a pain in the butt, the seller can just say no and walk away at any time. So we're still trying to build a good working relationship while being thorough in our requests. Not everything is going to apply. There's going to be items, even if you do your best, you're going to come up with like requests because you're not sure. Are there any long-term employee contracts? Maybe yes, maybe no. Probably not, but maybe. You got to ask the question and they're going to tell you if it doesn't apply. Are there any receivables, or is it just a purely cash-based business? Those kinds of things are questions that you want to ask. I would say never leave the question unasked, but be prepared that it may not apply. And on the sell side, when you're getting ready to sign your LOI, you should kind of tee up your team, your attorneys, or your accountants and your admins on what they need to pull. And I'd say also divide and conquer. The thing that can slow the process down the most is if you have one person trying to pull every single item on this list. And the easiest way we've seen, and we always kind of advise our sellers, is have your team ready and divide and conquer. Like break out the legal line items, like the entity formation documents, bylaws, give those to your attorney so they can pull those. They'll probably have them on file. The financial items, give them to your accountant. The HR items, give them to your HR person. So don't try to have one. If you're trying to have one person pull every single item on the list, it's gonna take forever, and they're probably not gonna sleep very well for a while. So, but this is our chance to be thorough, and that's, and once you get through the initial list, you're going to give them everything. They're going to probably spend a couple weeks with it, and then they're going to come back with more and follow-up questions and just have more discussions. But beyond just the paperwork and beyond just the documents, this is also going to be the time when we would start talking about going out to visit the location, visit the sites, maybe potentially meeting key employees. That's a very big judgment call you'll often see. In our experience, 9 times out of 10, the employees don't know that they're being sold. And the sellers like to keep it that way because they're very worried about an employees worried about their jobs or trying to jump ship or going somewhere else. And so oftentimes, the average employees don't know that they're being sold until they've been sold, After the paperwork signed, they'll close the documents. The old boss comes in with the new boss and says, we got some new partner in here. Congratulations. The new guy brings donuts or something to win some good favor points, and we kind of build the relationship from there. But by the time, the usual exception here is if you have one or two key employees who are really running the business. They're the core of the business, whether it's your general manager, your sales director, the person who if they leave, they're going to break the business. That's usually the people that you often see you want to have introductions with or have meetings with to kind of do what we need to do to keep this person on after closing. What are they looking for? Those are the conversations. This is the time to have those so that you can be ready when the bank gives you the green light to move forward to legal. And so this is often the times where we see, this is when we get all the ink, all the red lines, and we start going back and forth and fighting over nitpicking little terms because this is what we're best at. So typical legal documents you'll see, there may be others, there may be less. You're going to see a purchase agreement, whether it's a stock purchase agreement, asset purchase agreement. That's the core document. There's going to be disclosure schedules. Usually those get filled out closer to closing. It's just think of those as kind of like a snapshot of what the business looks like at the time of closing. Here are our major contracts. Here's the intellectual property we have. Here's the real estate we have. Here's our employees at this point in time. Here are the benefits we're paying those employees. Things like that. Here's our current receivables at this time of closing. It's kind of think of it as a snapshot about what things look like at closing. Then there's typically going to be a promissory note, for whatever the seller's carrying. Sometimes there's more than one. Oftentimes they'll want to have a security agreement with the seller so they can have some level of security. Now there's going to be some debate between attorneys on what we can do to secure a seller note. If the seller's keeping a promissory note, they're going to want to have as much security as possible. Often they may ask for a personal guarantee. Some of them have even asked for a mortgage on a person's house. Realistically, you can certainly ask. You're here to be their advocate and try to be realistic. But I also think this is a chance to be reasonable, moderate their expectations. Because keep in mind, if this person's buying with an SBA loan, they don't have the money to pay you if they default. And keep also in mind that the SBA gets first priority lien on everything they own. So if the business goes under, the SBA is going to take what they got, and you're going to get whatever's left. So the cold hard reality is there's really no way to give a seller 100% security on a promissory note. And that's kind of just, that's part of the reason we go through the due diligence, part of the reason we get to know the buyer and seller, and there needs to be a connection. Because if they don't like each other, they don't trust each other, they're not going to work well together, and this is probably not going to work. If that's at the other side of the coin, no buy. I've never met a buyer who's willing to pay 100% cash up front for a business from a person they don't know. So, there's got to, at some point in the day, that emotional connection and the trust has to be there to some degree. Trust verified. We can do what we can to give security, but realistically, there's only so much you can do. You got to realize whoever's giving out the most money gets first crack at it. Usually that's the SBA bank. So.
Jerry,
Yes.
unfortunately, this is the 5-minute warning.
Oh my. Okay. So.
Yeah.
Well, I got most of it. I'll have my lower little.
It's been great so far. There's been tons of nuggets.
I think I worked my soapbox in throughout. So
You did.
after the security agreement is the bill of sale. It's usually pretty straightforward. These are the we're giving all these assets over to you. And then the assignment of contracts. Here are the contracts we're turning over to you. Sometimes you can combine them into one. The transition agreement, and then usually there's a transition. Sometimes there's an employment and consulting agreement. The way I view it is the transition agreement covers all the free services that are included in the purchase price. You're going to make introductions to clients. You're going to be available if we have questions about where things are stored and saved. You're going to be there for we typically say at least for 14 days to kind of help us find everything and make introductions to the staff. Beyond that, if you want us to stay on for 2 years, you have to pay us, and that's where the employment or the consulting agreement comes on. So that's where I kind of keep those two buckets separate. Make it very clear what you're required, what you're doing for free as part of the sale, and what's going to be required extra compensation on top. Then you have the closing. These days, it's usually all electronic. pre-COVID, there was times we would still have people come by and meet together in person, but it's not like you're closing on a house, you go down to the title company and sign the papers. Usually the contracts are signed and scanned back and forth to each other. The only real in-person signing typically happens when the buyer goes to their bank. They'll sign at the bank on the day of closing, and then the bank will wire money into your account. So it's all usually done pretty hands-off. So, and that's when you also start working on when the takeover is and when the transition is going to happen and introductions. So this is when we as the attorneys and the brokers and the accountants step back, and when we have to kind of let the sellers and buyer work together and kind of get along or not get along at that point in time. So, sink or swim. So quick considerations for attorneys. I kind of touched a little bit on this. Number one, should always be wondering, are we being the most effective with our time and our billables hours? I come from a contracts and litigation background where we want to always go for that perfect contract. We want to get everything what our client wants, win every fight that we can, come out 100%, screw the other guy, do what we can to win. That's not really going to be the chance in this type of industry. We were looking to be competent. They're not looking for the best attorney money can buy 9 times out of 10, because they can't afford the best attorney money can buy. They're looking for somebody who's competent, knows what they're doing, is going to protect their interests without breaking the bank and driving them, eating up any profits they might have from the sale. So they want to make sure that you, as their advisor, not only have their best interests at heart, but are also mindful of what their budgets are. Are we mindful of what the client actually wants and needs out of a deal? I have an object lesson. If I have time, I'll get to it. But we had a deal where, the client, the buyer, and the seller, they came together. They negotiated these points on the general LOI. They came together. They were happy. And then the attorney came in and decided, no, you should get this. You should get that. You should change this deal. You should be asking for this. You should be asking for 100% guarantee first position lien on their house. You shouldn't settle for anything less than this. You shouldn't have a financing contingency. If they can't get financing, they should lose their deposit. And the attorney comes in telling them that the fantasy of what they should be getting in a 100% perfect deal, and the buyer and the seller, in this case, never having done this before, they trust their attorney. It's like, yeah, I should get a better deal. I should hold out for a better deal. And it fell apart. 3 times. 3 different buyers fell apart. And the guy still listens to his attorney. So we need to manage our clients' expectations and have realistic expectations. I didn't get into it. That would be the hot topic that I was going to get into was working capital. It's always a big bone of contention. We can always get into that maybe in the sequel. But that's usually one, your client has to, for a buyer, how much money should we be reasonably expecting to bring in here as capital to start the business on top of buying? You just paid $100.5 million for this business. How much money do you need to bring out of pocket to keep the lights on? Or, the other side of that coin, you bought this business, but if the owner takes all the cash out of it, all the receivables, and you're stuck with bills from day one, and it's going to be 60 days till your first service gets paid, how do you keep the lights on? How do you make payroll? That's where working capital comes in. And obviously, there's different sides and everything. The sellers are always going to be, it's mine, money, mine. But I always kind of like to use the analogy, if you go to the car lot and buy a car, but then they charge you extra for the gas to get to the gas station, I mean, you wouldn't take that. If they sold you the car but it was empty and you have to push it to the gas station, you wouldn't buy that car. You'd walk away. So you don't need to give them a full tank and everything in the bank, but you need to give them enough working capital, usually in receivables, not even cash, to get to the gas station. It's always the analogy I use. Same thing typically when we are we trying to facilitate the deal or try to get our clients to renegotiate? Oftentimes I see it most often because oftentimes the clients will do the LOI themselves, and then they'll bring the attorneys in for the legal documents, which there are values to it. Either way, I think you should consult, but obviously it's about managing your expenses, and then the attorney again tries to change everything in the document. I think at some point we have to agree that what our clients want to do and how can we facilitate this while mitigating risks as best as possible. And I think most importantly, are we making the process simpler or more difficult for our clients? Realistically, the perfect deal is never going to exist. You're never going to get 100% about what you want out of a sale or purchase of a business. There has to be some give and take. There is negotiation. You know, the mark of a good compromise is nobody walks away happy. But we need to understand that as advisors, and we need to keep our clients mindful of that. That, you know, if we keep telling them for this fantasy, this push and push and push, they're going to turn away perfectly good offers and deals, holding out for the purple unicorn that shits rainbows. So, and then, you know, at the end of the day, you know, if we're going to push on something, if there's something that you do think is important, you know, we have to have a conversation with our clients. You know, this is something that you'd like to change. Is this a die-hard thing? We live or die on this hill, or is this something that we push on? See if we can get something, but if they're not willing to budge on it, we can move on and live with it. It's really managing those expectations. So that was it. I think I burned through my Q&A time, but if we have any other questions, like I said, if you guys have any follow-up questions, you can always reach out to me. That's my email. And every attorney who's done at least one M&A transaction always has their own document templates they love to use, which they're never the same as other attorneys, so they're always going to get marked up, but it's always a good starting point. And if you find yourself in a deal and you want to either talk about anything, or if you want to just talk about some templates or resources, I'm always happy to help out where I can.
And it's okay if I send them the slide deck?
Yeah, go for it.
All right. Thanks, Jared.
Very good.
We'll officially stop this, and if there are any questions, you guys can ask.